Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature. None of which relied upon as any form of advice at all. FP Markets does not know your personal scenario, nor your personal financial goals, and therefore none of which relied upon as any form of advice at all. Is just general in nature only. CPI action, and I think that's the only way to say it. It is consumer price action across this entire week. It's an incredible amount of data to be dropping, and the question really is, how many new multi-decade highs are we going to see in this read? Australia, France, Germany, Italy, the US with PCE, Japan, and then the periphery nations in the European Union as well, all out with either July or quarter data for us here in Australia, and it is going to be quite a jump. So the question as we keep asking is, how high does inflation get, and therefore how many rate rises are we going to need? We also have the ECB coming out last week with a rate rise not expected of 50 bips, but then also this week you get the US Federal Reserve, and it's going to be quite a meeting. The expectations around 100 basis points has dropped back off. Currently the pricing sits at about 79 basis points, so lock in 75. There's a slight tinge of maybe 100. It's probably unlikely, considering even the most hawkish players out there, in terms of someone like Jamie Bullard or Esther George, even they are not saying that 100 points is going to happen. But that PCE metric is the one to watch. And the reason for it is that that is the Fed's preferred measure of inflation. And we need to see if it is going to a level that they do not want, which is upwards rather than downwards, or at least plateauing. And at the moment, signs are it's going up. You then also need to look at what's going on in the euro, because at the moment, what happened last week from the ECB, what caught my attention is that, yes, they caught the market off guard by going 50 bips, but then they are having to put in mechanisms that are now around new bond buying programs that are unlimited as far as we can see so far, to support the rest of the periphery that are highly indebted and would therefore face borrowing costs they can't sustain. This is the problem with the Eurozone itself, is that how does it fund the parts of the overall economy in that zone that aren't performing that well with those that are? And that is where the big question comes. It probably explains why there is a muted reaction once the drop came out on euro dollar. Yes, it recaptured parity as it should have, and yes, it's back at 102 because we've now seen the ECB moving and they're forecasting further rate rises to come. The caveat being is that they are countering that by making sure that the periphery doesn't get left behind. And that is why, from my perspective, the euro now is just peak volatility and maybe a bit hard to look at.